Has housing recovery hit a wall? And has the reliable Federal Reserve done what it's done so many times in the past? Changed its position? Let's take a look at what happened this week. Before we begin, remember to like this video and subscribe for more economic updates. Fed Chair Jerome Powell's appearing to do another of his famous about-faces away from his recent upbeat stance on rate cut prospects in 2024. Powell said, "More recent data shows solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal," later adding, "We can maintain the current level of restriction for as long as needed." Right now, it's anyone's guess as to how long that might be. For their part, traders are betting we won't see the Fed's first rate cut until September. Among the week's other highlights were several updates on the health of the housing sector, including the National Association of Home Builders Housing Market Index for April. On Monday, the NAHB reported that its index measuring confidence among builders of single-family homes was unchanged in April after rising 4 straight months. The repeat measure of 51 means the index remains slightly above the key level of 50 that distinguishes positive sentiment from negative sentiment among home builders. In a statement, NAHB Chief Economist Robert Dietz said, "April's flat readings suggest potential for demand growth is there, but buyers are hesitating until they can better gauge where interest rates are headed." Unsurprisingly, analysts say concerns about the interest rate environment impacted another high-profile housing metric out this week. On Tuesday, the Commerce Department said that housing starts fell nearly 15% in March to a seasonally adjusted annual rate of 1.32 million. After surging almost 13% in February, starts were expected to drop in March, but not this much. Economists were looking for a decline of about 3% to a rate of 1.5 million even. The Commerce Department's report on building permits, an indicator of future housing demand, was disappointing. Permits fell by 4.3% to a seasonally adjusted annual rate of 1.458 million. Economists had been expecting permits to be issued at a rate of 1.51 million last month. In other news this week, it appears February's surprise uptick in the Conference Board's leading economic index, the first one in nearly 2 years, was not the beginning of a brand new trend. The board reported on Thursday that the LEI resumed its downward direction in March, declining 0.3% after rising 0.2% the previous month. In a statement, the board said, "Overall, the index points to a fragile, even if not recessionary, outlook for the U.S. economy. Indeed, rising consumer debt, elevated interest rates, and persistent inflation pressures continue to pose risks to economic activity in 2024. Finally this week, the New York Fed's Empire State Manufacturing Survey for April revealed persistent weakness in manufacturing activity throughout the New York region. Earlier in the week, the regional central bank reported that the survey's primary index, the General Business Conditions Index, not only indicated contraction for the 5th straight month, but also came in well below projections. After posing a dismal minus 20.9 in March, the index was expected to come in at a significantly improved minus 5.2 this month. Instead, it registered an uninspiring minus 14.3, still well entrenched in contraction territory. That's all for now. I know it's hard to keep track of what's going on when the data moves around so much and the Federal Reserve is not to be counted on. But it's important to stay informed. So join us again next week when we go back at it. For now, this is Devlin Steele for Augusta Precious Metals signing out.